in Paris. Let's get to David Costa. He's Dean at Robert Kennedy College and joins us now from Zurich. David, you're calling for a low but firm recovery in the Eurozone this year, but challenges do remain. What are the biggest obstacles to growth?
Well, the biggest obstacle is really find a formula to reignite the economies in Europe and really reduce this high unemployment that we have seen particularly concerning for the youth unemployment. So that's really a big challenge, which, as we have seen from the speech of Mario Draghi, is something that the European Central Bank clearly cannot tackle because it's far outside their mandate. So for that reason, I think that will be a challenge on the short term. That said, it will take a bit of time, but I would see a slow improvement as on the job market if we see lending coming back from many of the European banks.
Should we not be concerned about core Europe, David, especially with elections looming in September in Germany?
Well, certainly that's one of the concerns that we can have on the horizon, but I would say that the political risk was not the main cause of the crisis last year. Besides the fact that what the market wanted to see last year is really some decision with the ECB, and as we have seen, this monetary program probably will not even need to be used. So I would say we have also election coming up in Italy and a lot of things going on the political front, but what the market really wanted was to be sure that there is a lender of last resort like the ECB has clearly said they will be, and that I think has calmed the market pretty much. So I don't see the political risk as being so important, particularly on the core Europe.
All right. The European banks, David, are still deleveraging, though, but you make the point that European companies with exposure to higher growth economies are still good investment opportunities this year. Make your case.
Well, I think at this stage, I wouldn't really go to a particular sector, but I would try to have a very broad exposure in Europe, particularly from those European companies which are, yes, based in Europe, where we will have a very, very low growth, but they have an exposure to emerging markets and to high-growth markets. So I would really try to be in the European multinational, which have a potential upside. I will try to be particularly on the broad market, and I think there we're going to see some more positive reaction this year, even though if we had a very, very big run up also last year. So there I see space for companies which will do well also in 2013, particularly those companies which have found a way to have good results despite the very low growth in Europe.
David, very finally, isn't it a cause for concern for investors that we still haven't seen the final shape of a European banking union? How concerned are you about that?
Well, that will take a bit of time. I don't think on the immediate term there was a huge problem. Of course, it will be very positive to harmonize the banking situation throughout Europe, have a single regulator, but it will take time, like everything in Europe. So on the immediate term, I think what was more important is to know that the financing of the bank has improved. And we've seen on the latest international bond issue of both Intesa Sanpaolo and Banco Bilbao that financing now is available to the bank. So what the ECB thinks will happen, and what I also think will be the main engine to reignite a little bit of growth in Europe, will be having lending back to the table to small businesses, and also a sentiment improvement throughout Europe, which of course without access to credit is very difficult to achieve. So I see that happening particularly as banks start to lend again and confidence in businesses will start hiring again, hopefully.
And how strong is the case for peripheral Eurozone debt and equities, David, in your opinion, now that the ECB has stepped in and arguably taken out all the tail risks?
I think it's a pretty strong argument. As also last year, I have been throughout the year pretty optimistic because I saw that many of the risks that particularly overseas investors saw in Europe were not really that real. So just 6 months ago, we were talking about the Europe not surviving, and we know now that there is a strong will to keep the euro intact. And so that goes by itself that the peripheral economies also will improve, particularly if the financial situation has already improved. Financing has been, for example, for Italy at the lowest since at the same level of 2010, so the improvement have been really, really broad, particularly for the biggest risks, which were Italy and Spain. So unless we really see some big surprise, but in that case, the ECB seems to be ready to intervene, I don't see the highest perceived risk that we had in 2012 to continue in 2013.
David, we've got to leave it there. It's always a pleasure talking to you, sir. David Costa there from Robert Kennedy College, joining us live out of Zurich. Thank you. All right, let's get to Stefan Pedrazzi now for a